In the silent, pressurized corridors of high finance, a tectonic shift of capital is occurring that dwarfs the headlines of the daily news cycle. And while retail investors are distracted by the volatile swings of social media trends and political theater, the world's most powerful financial entity, BlackRock, has begun moving trillions of dollars with surgical precision. This is not a matter of speculation or a collection of rumors whispered in dark corners. This is a documented repositioning of hard assets that signals the dawn of a massive global wealth transfer. To understand the gravity of this moment, one must understand the sheer scale of the player involved. BlackRock manages approximately $14 trillion in assets. They are not merely participants in the global economy, they are effectively the landlords of the stock market. If the financial world were a sprawling urban complex, BlackRock would own the ground lease, the air rights, and the infrastructure connecting every building. Their reach extends into nearly every retirement fund, every pension plan, and every major corporate board on the planet. When an entity of this magnitude decides to relocate capital, it is never a decision born of emotion or a reactive hunch. It is the result of a cold, calculated analysis of mathematics, policy, and probability. The data reveals a startling reality that most people are missing. BlackRock has recently shifted $2 trillion of exposure away from the United States, rotating those funds into emerging non-US markets. This represents a staggering departure from the American-centric investment strategy that has dominated the last decade. It is important to maintain perspective. This does not signal an immediate collapse of the American economy, but it does signal a definitive rotation of returns. Capital is like water. It possesses no loyalty and always seeks the path of least resistance to find the highest ground. While the average person reacts to the frantic headlines of the day, institutional giants move long before the ink on those headlines is even dry. They possess armies of analysts and proprietary data sets that cost millions to maintain, allowing them to see the ripples in the water before the wave ever breaks. For the individual observer, the secret is not to try and outwork their data, but to simply watch their hands. By observing where the money is actually flowing, rather than listening to what is being said in public relations statements, a clear map of the future economy begins to emerge. The primary driver of this massive relocation is the simple math of purchasing power and currency valuation. Last year, the United States dollar experienced a significant erosion of its value, which directly impacted the real returns of domestic investors. If a portfolio remains stagnant while the currency it is denominated in loses value, the investor has effectively lost money in terms of real-world purchasing power. This loss of utility drives the search for greener pastures where the tailwinds of currency and growth align. When the dollar weakens, foreign assets receive an inherent boost. An investor in a foreign market during a weak dollar cycle benefits twice. Once from the appreciation of the asset itself, and again because the foreign currency gains value relative to the dollar. This double return is exactly what the smart money is chasing. Last year's performance numbers illustrate this gap clearly. While the S&P 500 provided a respectable return of approximately 16%, international markets outperformed it significantly. Germany saw returns of 22%, Japan surged by 26%, and certain international sectors returned nearly 30%. The message from the market is clear. The era of American exceptionalism and equity returns is facing a sophisticated challenge from the rest of the world. This transition is not about abandoning the United States entirely, as the nation will continue to lead in sectors like artificial intelligence, defense, and high-level technological innovation. However, institutional capital does not reward past glory, it rewards future velocity. The current political landscape in America, characterized by high levels of uncertainty and policy volatility, acts as a deterrent for big money which prioritizes stability and predictability above all else. Markets loathe the vacuum of certainty, and when the political climate becomes too turbulent, money begins to search for safer, more accelerated pockets of growth elsewhere. In the last year alone, $48 billion in foreign capital exited the U.S. financial system. This was not a random occurrence, but a coordinated exit. As this money leaves, it seeks the demographic advantages of emerging nations. Countries with young, growing workforces represent the engines of future consumption and production. While the West faces the challenges of an aging population and stagnant workforce participation, the emerging world is just beginning its ascent. This is the fundamental reason why the largest asset managers are looking toward the horizon, positioning themselves in the path of the next great economic expansion before the window of opportunity closes for everyone else. Building upon this migration of capital, the focus shifts to the specific vehicles being used to capture this international momentum. While the average person is often paralyzed by the complexity of global markets, institutional players use a basket approach to mitigate individual country risk while capturing broad regional growth. The first major instrument in this strategy is the Vanguard Emerging Markets ETF, known by the ticker VWO. This fund acts as a direct passport to the world's fastest growing economic engines, including India, Brazil, and Taiwan. The shift toward these regions is driven by a cold demographic reality. While the Western world faces an aging population and a shrinking labor pool, these emerging markets are fueled by young, aggressive workforces. These are populations that are actively building infrastructure, consuming goods, and driving innovation at a rate that mature economies can no longer sustain. Last year, this sector returned a solid 25%, yet the current price action remains deceptively calm. For the professional investor, this lack of volatility is a signal, not a deterrent. Institutions do not chase vertical price spikes. They accumulate during these periods of quiet consolidation. Investing in this space today is the functional equivalent of entering the American market 2 decades ago. It is a long-term play on the next generation of global superpowers. The second component of this global rotation involves a country many had written off years ago, Japan. The EWJ, which tracks Japanese equities, has recently defied conventional wisdom by returning 24% last year and showing massive year-to-date strength. To the uninformed, Japan is a stagnant economy trapped in a demographic decline, but the smart money sees a profound structural reset. Japanese corporations are undergoing a massive overhaul of their governance, shifting their primary focus towards shareholder returns and operational efficiency. Furthermore, the persistent weakness of the yen has turned Japanese exports into a global bargain, essentially serving as a massive stimulus for industrial giants like Toyota and Sony. This isn't a mere temporary bounce. It is a total recalibration of how Japanese business operates. For an institutional manager, Japan offers a rare combination of a stable, high-tech government and a currency tailwind that pushes corporate profits to record levels. By the time the general public realizes that the old Japan is gone, the bulk of the valuation recovery will have already been captured by the early movers. Beyond individual nations, the broader Emerging Markets Fund, IEMG, serves as the ultimate macro tool for the world's largest banks. Returning 34% last year, this fund is used when institutions want to bet that the rest of the world will simply outpace the United States. This isn't a gamble on a single variable. It is a strategic position based on the reality that places like Singapore and India are becoming the new hubs of global trade. When you see headlines regarding political drama at global summits or erratic policy announcements from Washington, the natural human instinct is to panic. However, it is essential to understand the psychology of the market. Money never truly leaves the system. It simply moves tables. A pullback in American stocks is often just the sound of billions of dollars being reallocated to these international baskets. There is a fundamental rule in global finance. Every major rotation feels uncomfortable and risky right before it becomes obvious to the masses. The greatest mistake an individual can make during this transition is waiting for certainty. In the financial world, certainty is the most expensive commodity you can buy. By the time the news cycle confirms that a trend is safe and the waters are clear, the professional class has already moved on to the next opportunity, leaving retail investors to buy the top. BlackRock and other giants are not predicting the future with a crystal ball. They are simply responding to current data regarding currency shifts and policy changes. If you wait for an official all-clear signal, you are essentially volunteering to be the liquidity for the institutions that are exiting their positions. The goal is not to trade out of fear, but to operate with a heightened sense of awareness. You don't need to abandon your domestic holdings, but ignoring $1 trillion rotation while the largest asset manager on earth is signaling a move is a risk that few can afford to take. One must learn to follow the footprints left by the smart money and position themselves where the capital is flowing, rather than where it has already been. While the movement of trillions into foreign equities is a massive story, there is another shift occurring in the deep shadows of the financial system, one that involves the fundamental reclassification of gold and silver. For decades, the global banking establishment treated gold as little more than a shiny pet rock, a legacy asset that was aesthetically pleasing but functionally inert on a modern balance sheet. It was considered a deadweight asset because it couldn't be easily leveraged for credit. However, the rules of the game have been quietly rewritten. Gold has recently been elevated to a Tier 1 liquid asset. In plain English, this means that central banks and massive institutions like JP Morgan and Goldman Sachs can now count their gold reserves as the functional equivalent of 100% cash. This reclassification has transformed gold from a passive safety net into a potent financial weapon. It can now be used as direct collateral to secure loans and generate massive amounts of leverage. When the world's largest banks realize they can use gold to effectively print more money, their demand for the metal shifts from a defensive hedge to a primary utility. This systemic change is the true engine behind the recent all-time highs we have seen in precious metals. It isn't just a fear trade driven by geopolitical anxiety. It is a calculated response to a change in global banking definitions. BlackRock is deeply integrated into this transition, and because they manage a significant portion of the world's 401k and pension assets, these shifts in Gold AS utility impact the underlying value of retirement accounts even for those who have never purchased a single gold coin. The definitions are changing, the assets are being moved, and the institutions are doing it without the fanfare of a public memo. This is part of the broader panic playbook that the professional class uses to maintain their advantage over the general public. If you understand the script, you can see that market volatility is often manufactured to induce a specific emotional response from the retail investor. The playbook is remarkably consistent. Bad news is almost always strategically released on weekends when the markets are closed. This timing is deliberate. It forces the average person to spend 48 hours in a state of escalating anxiety, fueled by social media speculation and alarmist commentary. By the time Monday morning arrives, the goal is for the public to be so terrified that they are willing to sell their shares at a significant discount just to find relief from the stress. This creates a dip, or a liquidity event, where large institutions can step in and buy those same shares cheaply. By midweek, the tone of the news cycle inevitably shifts. Rumors of productive negotiations or stabilizing factors begin to surface, the market rallies, and by Friday, the very institutions that triggered the panic are booking massive profits. It is a cycle of wealth transfer powered entirely by the emotional exhaustion of the public. Consider the recent discourse surrounding global tariffs and trade wars. For several cycles now, the public has been bombarded with the threat of new economic barriers, yet specific, actionable legal details remain suspiciously absent. This vagueness is a feature, not a bug. Uncertainty is used as a tool to keep the market in a state of perpetual overstimulation, which makes it easier to hijack the emotions of individual investors. The entire financial ecosystem, from the red flashing numbers on a trading app to the breaking news alerts on a smartphone, is engineered to create a traumatic experience with money. The system wants you to see red, feel your heart race, and hit the sell button. To survive this environment, one must learn to resist the urge to react. The most powerful move an investor can make during a period of manufactured chaos is to do nothing, to close the app, step away from the screen, and wait for the logic of the math to override the noise of the news. The struggle to remain rational in an irrational environment is the final hurdle for any investor seeking to capitalize on this global rotation. While knowing not to panic is essential, the strategy is incomplete without a clear understanding of where to allocate capital when the rest of the world is paralyzed by indecision. As trillions of dollars exit the traditional safe havens of the American indices, they are not just flowing into foreign markets and gold. They are also flooding into a specific domestic sector that historically thrives on geopolitical friction and systemic chaos. This sector is the backbone of global stability, yet it remains overlooked by the masses who are too focused on the latest tech bubble or real estate fluctuation. This particular industry has a proven track record of outperforming the S&P 500 by double digits during periods of high tension because it provides the essential infrastructure and security that governments and corporations are willing to pay any price for when the world feels like it is coming apart at the seams. The institutions understand that while consumer trends and discretionary spending may fluctuate during a transition, the demand for defense, industrial energy, and resource security is inelastic. As the landlord of the stock market, BlackRock is already deeply entrenched in these sectors, reinforcing their positions while retail investors are distracted by the noise of the weekend news cycle. The window of opportunity to enter these trades at a reasonable valuation is closing rapidly. Once the mainstream financial media begins to report on these moves as a new trend, the premium will have already been baked into the price, and the potential for explosive gains will have diminished. The goal is to move with the same cold, calculated logic as the giants, positioning yourself early, maintaining a long-term horizon, and ignoring the emotional hijacking of the 24-hour news cycle. The current economic landscape is not a signal of the end, but rather a massive reorganization of the world order. We are witnessing the birth of a multipolar financial system where the United States remains a powerful player, but no longer the only game in town. By diversifying into emerging markets through vehicles like VWO and IEMG, recognizing the structural transformation within Japan via EWJ, and understanding the new Tier 1 status of precious metals, an investor can build a portfolio that is resilient to domestic volatility. This is about more than just numbers on a screen. It is about recognizing the footprints of the world's largest asset managers and having the courage to follow them into the next era of growth. The system is designed to reward those who can see the big picture through the fog of daily distractions. Ultimately, the wealth transfer we are witnessing is a transfer of perspective. Those who view the market through the lens of fear and reactive headlines will inevitably see their purchasing power erode, while those who view it as a mathematical landscape of rotating capital will find themselves on the right side of history. The moves made by BlackRock and the quiet reclassification of global assets are the map. The only question remains whether the individual investor has the discipline to follow that map or if they will continue to be led by the emotional tides of the mainstream narrative. By staying focused on the structural shifts rather than the surface level drama, you can position yourself to thrive in a world that is being fundamentally rewritten.